Your mortgage payment jumps $2,000 overnight. It's 2:07 a.m. when your mortgage servicer app pings. Your payment amount has changed. You sit up and refresh twice. The new number stays there, plus $2,000. Not the interest rate, not a late fee, not a typo. You picked the fixed rate. The fixed rate is still fixed, the payment isn't. You think about the closing table. You think about the phrase fixed payment. You think about the first month you finally felt safe. And now the safety is gone. You scroll until you find the reason. One word that sounds like a boring office job. Escrow. You do the math in the dark. $2,000 a month is $24,000 a year. And you already spent your extra money on closing costs, movers, and the kind of one-time purchases that keep happening. You try to lie back down. Your body doesn't let you. The email has a PDF attached. Annual escrow analysis statement. You tap it with a shaky thumb. The statement is cold. The statement doesn't care you're awake. The statement doesn't care you're scared. The statement shows the numbers. Principal and interest stays unchanged. The part you locked in. The principal and interest line doesn't move. Then the escrow line blows up. Old payment, new payment. The old total is the number you built your life around. The new total is a different universe. And the breakdown proves it's not a glitch. County property tax is higher. Homeowners insurance is higher. The minimum required balance is higher. The projected escrow balance is negative. Negative means the mortgage servicer already paid bills with money you haven't given yet. The PDF feels like a confession. The PDF says the quiet part out loud. The mortgage servicer undercollected. The mortgage servicer paid the bills anyway. Now the escrow account gets refilled. By you. 2 words sit on the page like a threat. Shortage, cushion. Your payment isn't just going up. You're paying the past and the future in the same month. Escrow is a forced savings account your mortgage servicer controls. The escrow account exists to pay bills the lender cares about. Property taxes, homeowners insurance, sometimes flood insurance, sometimes HOA dues. The mortgage servicer estimates the next 12 months of those bills, divides by 12, and adds that amount to your monthly payment. Most first-time buyers don't get a real choice. If the lender requires escrow, escrow is mandatory. Because the lender does not trust you to hold tax money for 6 months and pay the county on time. But escrow is not your mortgage. Your loan payment is principal and interest. Escrow is taxes and insurance. Principal and interest can be fixed. Taxes and insurance can change. And when taxes or insurance jump, the mortgage servicer still pays the bills. The escrow account drains. Sometimes the escrow account goes negative. Then the annual escrow analysis shows up and hands you the math. The escrow analysis is the reset button. Undercollected means an escrow shortage. Overcollected means an escrow surplus. An escrow surplus can mean a refund check or a credit. Either way, the mortgage servicer recalculates and your monthly payment moves. That math includes a cushion. Federal rules under RESPA allow an escrow cushion up to 1/6 of the annual total. About 2 months of escrow sitting there just in case. So you don't just pay the new higher bills, you repay the shortage from last year, and you rebuild the cushion for next year. That's how just escrow turns into a $2,000 surprise. You stare at the escrow analysis like evidence. Because the escrow analysis stacks 3 charges into one moment. Higher monthly escrow going forward. repayment of last year's escrow shortage, rebuilding next year's escrow cushion. Imagine the old year looked like this. Insurance, $2,400. Taxes, $4,800. Total, $7,200. Monthly escrow, $600. Now imagine renewal hits. Insurance renews at $6,600. Taxes jump to $7,800. Now taxes and insurance add up to $14,400. Monthly escrow should be $1,200. That's plus $600 a month before anything else. But the mortgage servicer has been paying $1,200 worth of bills while collecting $600. The escrow balance falls behind. That gap becomes the shortage. And here's the part your brain fights at 2 a.m. The escrow shortage isn't a brand new bill. The escrow shortage is a catch-up bill. The mortgage servicer already sent money to the county and the insurance company. Now the mortgage servicer sends the invoice back to you. Say the shortage is $6,000. The mortgage servicer gives you two options. Pay $6,000 now. Paying the shortage in a lump sum hurts once. Spreading the shortage hurts every month. And the mortgage servicer still adds the new $1,200 escrow going forward either way. Or spread $6,000 over 12 months. Spread it, and that's plus $500 a month. Then the cushion. 2 months of a $1,200 escrow payment is $2,400. Spread the cushion across a year, and that's another plus $200 a month. Now plus $600 becomes plus $1,300. And that's before flood insurance, before an HOA special assessment, before a reassessment pushes the tax bill again. And that's before a repair, before daycare, before a medical bill. You can see how a payment jumps $2,000 without the interest rate moving an inch. Your rate stays fixed, your payment doesn't. This isn't a "you messed up" story. This is taxes and insurance rising faster than paychecks. ICE Mortgage Monitor reports the average annual property insurance premium among mortgaged single-family homes rose by a record $276 in 2024, about plus 14%, to roughly $2,290 per year. ICE also reports the 5-year increase is $872, and ICE reports the insurance portion of mortgage payments up 52% since the start of 2020. In higher risk areas, ICE says the increase can be up to 90%. Another ICE report notes the average monthly principal, interest, taxes, and insurance payment hit a record $2,070 in August 2024. PITI is the acronym. Principal, interest, taxes, insurance. Taxes move too. ATTOM's 2024 property tax analysis shows $382.7 billion in property taxes were levied on single-family homes in 2024, up 5.3% from the year before. ATTOM reports the average tax on a single-family home rose to about $4,300 in 2024, up 5.8% year over year. Those are averages. Your escrow analysis statement is the personal version. The sun comes up. You pretend you slept. You call the servicer. You sit on hold. Then a human voice finally picks up. And the voice is calm. Too calm. Like you called about a missing password. The servicer agent repeats the standard escrow explanation. Your escrow analysis is based on your current tax bill and insurance premium. Your payment increased due to an escrow shortage. You can pay the shortage. in a lump sum to reduce your monthly payment. Otherwise, the shortage will be spread across the next 12 months. The servicer agent says cushion, like it's a pillow. The servicer agent says required, like it's gravity. You ask why nobody warned you. The servicer agent says a notice was sent. The notice is buried in a portal you never open. You hang up and realize something clean and brutal. You didn't buy a fixed payment. You bought a fixed loan inside an unfixed world. Your brain does something predictable when the payment changes. You anchor to the old number. That old payment becomes your identity, your routine, your safety. So when the new number appears, your nervous system treats it like danger. Fight, flight, freeze, you bargain. Maybe it's a mistake. Maybe they used the wrong policy. Maybe the county will reverse it. Maybe the servicer miscalculated. You open your bank app. You count paychecks like they're oxygen. Cut subscriptions you don't even use. You start selling things in your head. You feel ashamed because you thought buying a home was the responsible move. And now it feels like you got tricked by fine print. The worst part is the language. The statement calls it routine. Annual escrow analysis. Normal, automatic, like panic should be scheduled. At 2 a.m., you can't fix the county assessor. At 2 a.m., you can't reverse a hail season, but you can stop guessing. In the morning, you pull 3 documents: the escrow analysis statement, the property tax bill or assessment notice, the insurance declarations page. Then you call the mortgage servicer with specific questions. What tax and insurance numbers did the mortgage servicer assume for next year? Is the shortage spread over 12 months or due now? How big is the cushion? When is the next tax disbursement scheduled? Will a new insurance policy trigger a new escrow analysis, and how fast? You also ask about an escrow waiver. Some loans require escrow forever. Some loans allow an escrow waiver later, with enough equity and a fee. Then you do the only levers you control. Shop insurance, check appeal deadlines, file exemptions you qualify for, because escrow doesn't care how you feel. Escrow only cares what the bills say. It's 2:48 a.m. now. The house is quiet. Your partner is asleep. The street outside is dark, and the new payment is still there. You don't feel like a homeowner. You feel like an employee, working to feed a number that can change without permission. Tomorrow, someone else gets keys to their first home. They take a picture in front of the sign. They post it. They say, "We did it." And somewhere, a year from now, their phone will light up at 2 a.m. Your payment amount has changed. It's just escrow. Welcome to StatPsyche.